The development of banking institutions over time illustrates a process of adaptation to economic and geopolitical pressures, particularly those arising from major international conflicts. Banks that originated in various regions, including Europe and North America, managed to sustain their operations by aligning with the demands of wartime economies, such as providing loans for defense and managing treasury securities. This continuity was evident in entities that focused on neutrality or relocated assets to secure locations, allowing them to persist despite disruptions. Such institutions, often family-owned or state-supported, transformed their lending and investment practices to accommodate shifting priorities, from domestic stabilization to international coordination. This adaptability not only ensured survival but also positioned these banks to influence post-conflict reconstruction, highlighting the interplay between private financial interests and public needs. As conflicts intensified, the role of banks extended beyond national boundaries, intersecting with the formation of supranational bodies aimed at monetary cooperation. Institutions established to handle reparations and settlements from earlier wars evolved into mechanisms for broader financial stability, facilitating gold transfers and exchange deals even amid hostilities. These developments marked a transition from isolated national systems to interconnected global networks, where banks could expand their services to diverse entities. The persistence of these institutions through periods of upheaval underscores a critical aspect of financial history: the capacity to maintain profitability by serving multiple interests, including those in opposition. This raises questions about the ethical dimensions of neutrality, as banks navigated controversies over asset handling while prioritizing operational continuity. The interconnections among banking entities, forged through mergers, alliances, and family ties, further complicated this landscape. Prominent families with varied religious backgrounds maintained influence across generations, often through intermarriages and shared political engagements that facilitated the consolidation of resources. Post-conflict eras saw these networks contribute to the creation of global financial mechanisms, integrating historical institutions into modern frameworks. Critically, this evolution suggests that banking power has concentrated in ways that transcend national loyalties, potentially amplifying systemic vulnerabilities while enhancing efficiency. The following analysis explores these dynamics, examining how survival through conflicts shaped the contemporary global financial order. Historical foundations and survival through conflicts. Banking originated as a localized activity, serving communities within city-states or regions by managing deposits, loans, and exchanges for merchants and local authorities. In medieval Europe, institutions in Italian city-states advanced these practices, supporting trade and governance within confined territories. This local focus limited exposure to broader disruptions but also constrained growth, as banks primarily catered to immediate economic needs without extensive cross-border involvement. Over time, as states centralized power, banking expanded to national scales, with central institutions emerging to stabilize currencies and finance government operations. These national banks provided services to citizens across entire countries, marking a shift from regional fragmentation to unified domestic systems. Major conflicts accelerated banking's internationalization, compelling institutions to adapt by offering services beyond national borders. Banks that endured these periods did so by maintaining lending during hostilities, funding war efforts through bond purchases and credit extensions. Entities in neutral locations, such as Switzerland, continued operations by handling transactions for multiple parties, including gold shipments to safer havens. This neutrality allowed them to preserve assets and fulfill pre-existing obligations, even as controversies arose over dealings with occupied territories. Critically, such practices reveal a tension between ethical neutrality and practical complicity, as banks indirectly supported conflicting interests to ensure their own viability. Post-conflict adaptations further entrenched this international orientation, with surviving banks expanding through mergers and alliances. Institutions that provided financing during wars increased revenues by lending to reconstruction projects and emerging markets. This expansion involved forming connections with banks in diverse regions, enabling services to opposing entities in subsequent disputes. The critical implication is that banking's survival hinged on diversifying risks across geopolitical lines, fostering a system where profitability derived from conflict-driven demands. This pattern underscores how historical conflicts not only tested but also propelled the globalization of finance, transforming once separate national entities into interconnected networks capable of operating amid opposition. Role of supranational institutions in financial stability. The establishment of supranational financial bodies represented a pivotal response to the instabilities of international conflicts, aiming to foster cooperation among central banks. One such institution, founded in the early 20th century in Switzerland, initially managed reparations from a prior war, handling payments and settlements between creditor and debtor nations. Its neutral stance during subsequent hostilities allowed it to continue limited functions, such as facilitating asset transfers and exchange operations. Owned by member central banks, this body evolved from a reparations agent to a coordinator of monetary policies, reflecting the need for mechanisms that transcend national rivalries. During major wars, these institutions engaged with entities on opposing sides, adhering to neutrality declarations that restricted but did not eliminate services. For instance, gold transactions and interest payments proceeded under pre-war agreements, even as some assets later proved controversial. Post-war, the focus shifted to reconstruction, returning disputed holdings and supporting payment unions to restore currency stability. Critically, this evolution highlights potential biases in neutrality, as operations sometimes favored resource flows to one party, raising questions about accountability in international finance. The institution's governance, involving boards of central bank governors, ensured collective control rather than dominance by any single nation. Today, located in Basel with additional offices globally, this body serves as a forum for central bank discussions, providing research, statistics, and banking services exclusively to its members. It hosts committees on supervision and innovation, acting as a trustee in international arrangements. This development from reparations management to stability promotion illustrates how supranational entities have integrated surviving banks into a cohesive framework. However, the critical perspective reveals limitations. While facilitating cooperation, these institutions may perpetuate inequalities by prioritizing established powers, underscoring the challenges of achieving truly equitable global financial governance. Banking families and their enduring influence. Prominent banking families played a central role in shaping financial institutions, often maintaining control through generations despite conflicts. Families of Jewish heritage, such as those originating in Frankfurt and expanding to major European cities, financed governments and infrastructure, supporting respective nations during wars. Their assets faced seizures in occupied areas, leading to post-war reorganizations. Similarly, Protestant and Episcopal families in the United States built empires through oil and banking mergers, contributing to war efforts and transforming interests into global corporations. Catholic families in Spain and secular influences in Asia sustained operations through civil and international strife, expanding regionally afterward. Interconnections among these families strengthened through social, religious, and political ties, including intermarriages within Jewish networks and business alliances in Protestant circles. These relationships facilitated mergers, such as those forming major U.S. banks, and influenced the creation of federal systems. Critically, this concentration of influence raises concerns about oligarchic tendencies, as family offices and board positions perpetuate control in specific countries and sectors. The diversity of religious backgrounds, Jewish, Protestant, Presbyterian, Catholic, did not hinder collaborations but rather enriched networks, allowing families to navigate geopolitical shifts. Post-conflict, these families adapted by merging entities into investment companies, focusing on wealth management and private equity. Their enduring stakes in global finance, through dividends and executive roles, highlight a shift from direct ownership to indirect influence via corporations. This evolution critiques the democratization of finance, as family legacies continue to shape profitability and stability, potentially prioritizing elite interests over broader equity. The interconnections underscore how historical survival translated into contemporary power, blending personal ties with institutional frameworks. Modern global banking landscape and mergers. Contemporary banking encompasses a range of institutions, from commercial banks handling deposits and loans to investment companies managing assets and broader entities like development lenders. Major banks today, particularly in China, are state-controlled with minority foreign investments from Western entities, reflecting post-reform integrations rather than direct dominance. In the Middle East and Asia, ownership varies by government links, family control, and sovereign funds, with Western survivors holding limited stakes for market access. This diversity critiques the notion of centralized control, as local structures predominate despite global interconnections. Mergers have defined the landscape, consolidating predecessors from centuries-old foundations into universal banks. U.S. institutions trace to early national banks, merging through acquisitions to expand in investment and retail services. European banks, surviving wars via neutrality, grew through nationalizations and international expansions. Critically, these consolidations enhanced profitability by overcoming restrictions, but they also amplified systemic risks through interconnected exposures. The resulting entities lead in assets and services, operating under business names that encapsulate their merged histories. Interconnections occur through lending, derivatives, and joint ventures, driven by dynamics of risk-sharing and regulatory compliance. Families retain involvement via stakes in private banks and asset managers, deriving income from diversified portfolios. This global web questions the balance between efficiency and vulnerability, as alliances foster stability while potentially enabling contagion. The landscape reveals how war-surviving institutions evolved into dominant players, blending historical legacies with modern operations. Contemporary state of global finance and control. The current global financial system features moderated growth amid uncertainties, with advanced economies slowing due to policy divergences and emerging markets driving momentum through exports. Inflation trends downward, enabling rate adjustments, though trade frictions pose risks. Digitization integrates blockchain and tokenized assets, enhancing efficiency but introducing cyber vulnerabilities. Critically, this fragmented landscape challenges uniform governance, as technological shifts favor multipolar influences over centralized dominance. Control resides in decentralized networks, with central banks setting policies and international organizations monitoring stability. Regulatory bodies enforce standards, while private banks and asset managers influence capital flows under oversight. This structure, evolved from post-war frameworks, emphasizes cooperation but reveals power imbalances toward major economies. The critical view highlights threats to independence from political pressures, questioning the equity of influence distribution. The evolution of global finance through conflicts demonstrates a trajectory of adaptation and consolidation, where neutrality and interconnections sustained institutions. Supranational bodies and family legacies shaped this order, raising ongoing concerns about accountability and inclusivity. Ultimately, the system balances innovation with risks, necessitating vigilant oversight to address inherent tensions. Conclusion: power concentration, ethical complicity, and systemic fragility in the global banking order. The evolution of global banking institutions through historical conflicts demonstrates a consistent pattern of adaptation, survival, and increasing interconnection. Originating as localized operations in medieval European city-states, banks expanded to national scales with the centralization of state power, providing currency stabilization and government financing. Major international conflicts accelerated this process by compelling institutions to internationalize operations. Banks sustained activities during hostilities through lending to war efforts, bond issuances, and credit extensions. Neutral locations, particularly Switzerland, enabled continued handling of transactions, including gold shipments and asset preservations for various parties, allowing pre-existing obligations to persist. The Bank for International Settlements, BIS, established in 1930 in Basel to administer post-World War I German reparations under the Young Plan, evolved into a central coordinator for monetary cooperation. It maintained limited functions during World War II, facilitating gold transfers, interest payments, and exchange operations under declared neutrality. Post-war, it shifted focus to reconstruction support, currency stability mechanisms, and eventually to serving as a forum for central bank governors, providing research, statistics, and exclusive banking services to members. Banking families across generations and diverse backgrounds, such as those originating in Frankfurt and expanding to European capitals, or U.S.-based lineages tied to industrial mergers, maintained influence through intermarriages, alliances, and reorganizations following asset disruptions. These networks supported government financing during conflicts and contributed to post-war consolidations into larger entities. Mergers and alliances in post-conflict periods transformed surviving institutions into broader universal banks, expanding services across retail, investment, and international operations. This consolidation integrated historical foundations into contemporary structures, with major players in the US, Europe, China, state-controlled, and other regions reflecting varied ownership models including government links, family stakes, and sovereign funds. As of 2026, the global financial landscape features moderated economic growth, downward inflation trends allowing policy adjustments, and ongoing digitization with blockchain and tokenized assets enhancing efficiency. Risks persist from trade frictions, geopolitical tensions, cyber vulnerabilities, and interconnected exposures in lending and derivatives. Supranational coordination through entities like the BIS, alongside central banks and regulatory frameworks, supports monetary stability and policy discussions. Interconnections via joint ventures, risk-sharing, and global services enable operations across diverse geopolitical contexts. The overall trajectory shows banking institutions adapting to wartime demands and post-conflict opportunities, evolving from isolated national systems into an interconnected global network capable of functioning amid opposition and change. This development has positioned surviving entities as key components of the modern financial order, balancing operational continuity with expanded scope and influence.